The property market is about to completely change forever, and something very strange is going on. Let me explain. Firstly, if you look at the media and what everyone's saying about UK property, it's all doom and gloom. I mean, there's a budget coming next year, interest rates are high, and some economists are predicting a crash. But the reality behind the scenes is far more complex and actually much more interesting. In the next 18 months, nearly 1 million homeowners are going to get a letter that could force them to sell their house. And the crazy part, most of these homeowners won't even realize it until it's too late. These letters are related to mortgage expiries and interest rate resets. When their fixed-rate deals end, the repayments for some homeowners could skyrocket, making it impossible to afford their current homes. And this isn't just a small group of people. This is a mass wave that could reshape the housing market as we know it. Now, let's dive even deeper into what's really happening behind the scenes. The forced sales wave isn't uniform. It won't affect every city or town the same way. Some regions are more vulnerable because they have higher numbers of homeowners on fixed-rate deals that are expiring at the same time. For example, cities in the Midlands and Northern England have a large concentration of people who bought during the cheap mortgage years. When their deals expire, they're facing huge repayment jumps. Meanwhile, London and the Southeast are behaving differently. Here, the market is more insulated because wealthy investors and cash buyers dominate. Even if some homeowners face higher payments, the influx of capital keeps prices steady or even rising. This creates a split market where some towns see plunging property values while others appear almost untouched. It's this split that makes forecasting so difficult. Analysts look at average prices across the country and say, property is falling 5%. But that number hides the truth. In some towns, values could drop 20%, while in others, they're climbing. Another hidden factor is the shadow market. Many properties that appear unsellable or abandoned are actually held by investors waiting for a bounce back. These investors often buy distressed properties cheaply and then rent them out, creating artificial demand. This is why even when headlines scream about doom, some areas show surprisingly stable prices. Then there's the psychological element. Homeowners hearing about doom start acting prematurely. They panic, list their homes, and trigger local price drops. Yet, in areas dominated by long-term owners or cash buyers, the fear factor is almost non-existent. The mix of forced sellers, strategic investors, and panic-driven decisions creates a patchwork effect that confuses even professional analysts. Interest rates play a massive role too. Central banks have been hiking rates to curb inflation, and while mortgage rates have already jumped, the worst is yet to come for many fixed-rate deals ending. A family that signed up for a 1.5% mortgage 5 years ago might suddenly face 6 to 7% repayments. That's not just stressful, it's unaffordable for many. And when affordability drops, forced sales rise. Forced sales don't just impact homeowners, they ripple through the entire economy. When people sell under pressure, they often accept lower prices, which drags down neighborhood values. Lower property values reduce the collateral people can borrow against, limiting spending on renovations, cars, or other big-ticket items. That slowdown hits local businesses, which then affects jobs and wages, creating a chain reaction. Another twist is mortgage lenders themselves. Banks and building societies monitor risk closely. If a region suddenly shows high default rates, lenders may tighten lending rules, making it harder for new buyers to enter the market. That lack of fresh demand pushes prices down even further, accelerating the forced sales cycle. Rental markets also feel the impact. Investors who bought properties during cheap mortgage periods may switch to renting instead of selling, aiming to cover costs while waiting for prices to stabilize. This increases rental supply, sometimes lowering rent prices, but in other cities with already tight housing, rents may still soar due to consistent demand. The government's interventions, or lack thereof, play a role too. Policies like Help to Buy, stamp duty holidays, or tax incentives temporarily boost markets. But when these incentives end, the sudden drop-off can create additional pressure. Some homeowners may have relied on these perks to make repayments manageable. So when support disappears, their options shrink, adding to the forced sale wave. It's a delicate balance. One policy tweak can stabilize one city but inadvertently pressure another. Forecasting the UK housing market today is like predicting weather in a microclimate. Local factors dominate. The psychological element in property markets is huge. When news outlets constantly report falling house prices, homeowners panic. Even if their personal situation is stable, fear of being trapped with an overpriced property can push them to sell prematurely. This self-fulfilling prophecy accelerates the downward spiral in certain regions. Interestingly, some buyers are watching this chaos as an opportunity. Investors and cash buyers, especially those from overseas, are scouting for bargains. They target areas where forced sales are concentrated, buying low with the expectation that prices will rebound. This selective buying creates a stark contrast. Some towns see steep declines, while others benefit from sudden investment influxes. Data also shows that first-time buyers are struggling the most. With interest rates high and wage growth not keeping pace, many young people are priced out. Instead of purchasing, they stay in the rental market longer. This increases competition for rentals, driving rents higher in some cities, even as house prices fall, a confusing dynamic for the average observer. Banks are now recalculating risk constantly. Advanced algorithms monitor payment delinquencies, regional economic shifts, and property sales. Lenders may refuse to renew mortgages for people in high-risk areas or demand larger deposits. This caution slows down transactions, making it harder for the market to stabilize naturally. Ultimately, the UK housing market is entering a phase of unprecedented regional disparity. Traditional average UK house price statistics may not reflect reality. Homeowners, investors, and policymakers all need to pay attention to microtrends and local conditions. National averages are becoming increasingly misleading in this volatile environment. Now let's consider the role of government policy. Recent fiscal decisions, such as changes in stamp duty and mortgage support programs, are having uneven effects. For example, first-time buyers in some regions benefit from temporary tax relief, making it easier for them to enter the market. In contrast, existing homeowners facing rising interest rates get no relief, increasing pressure to sell. Another hidden factor is the shift in population dynamics. Remote work trends have altered demand patterns. Towns and smaller cities with good connectivity are seeing higher interest, while traditional commuter belts near London experience slower activity. This migration reshapes local markets. Even areas previously considered stable are now unpredictable. The rental market, as mentioned, is becoming a pressure valve. While house prices fluctuate, rents in high-demand areas continue to rise, forcing more households to spend larger portions of income on accommodation. This has knock-on effects. Local spending falls, businesses struggle, and regional economies feel stress even before properties are sold. Institutional investors are also adapting. Real estate funds and pension-linked property investments are carefully choosing which towns to enter. They avoid regions with high for-sale risk and focus on areas with resilient economies or steady rental demand. This selective investment amplifies the disparity between regions. In short, UK property is no longer a uniform landscape. The next 12 to 24 months will see some towns plummet while others thrive. The key takeaway: national statistics hide extreme regional differences. Understanding these micromarkets is essential for anyone navigating or investing in UK real estate. Let's talk about the psychological factor influencing homeowners and buyers. Fear is now a major driver in the property market. Many people who purchased homes at historically low interest rates are panicking as their fixed deals expire. Even if they can technically afford the new rates, the anxiety of higher repayments is pushing them to list their properties sooner than planned. Media coverage intensifies this effect. Headlines highlighting collapsing house prices or mortgage crisis create a sense of urgency. Social media amplifies stories of people being forced to sell, which may not represent the full picture but affects perception. Buyer behavior follows suit. Potential buyers hesitate, wait for prices to drop further, or demand steep discounts, slowing the market. Another subtle influence is generational change. Millennials, now entering peak home buying years, face stricter lending criteria than previous generations. Combined with rising living costs, they are less willing to overextend financially. This contrasts sharply with older generations who purchased when borrowing was cheaper and are less likely to sell unless forced. Economic indicators like unemployment forecasts, inflation trends, and wage growth also play a silent role. Even modest warnings of slowing economic activity make lenders tighten mortgage approvals, reducing available buyers. This feedback loop between sentiment, lending, and property decisions accelerates the forced sale phenomenon in vulnerable areas. In essence, the UK property market isn't just about numbers or policies. It's deeply tied to human behavior. Those who understand this psychological dimension have a significant advantage in predicting which regions will face downward pressure and which will remain resilient. Now let's examine how the banking sector is reacting behind the scenes. Banks are bracing for a wave of mortgage defaults as fixed-rate deals expire. Unlike previous crises where lending was unrestricted, today's banks have stricter rules, which ironically can worsen regional disparities. Lenders are more cautious in areas with higher default risks, sometimes reducing the maximum loan-to-value ratios or refusing new mortgages altogether. This creates a knock-on effect. In vulnerable towns, fewer buyers qualify for mortgages, reducing demand and forcing sellers to drop prices. Meanwhile, in more affluent areas, lending remains stable. Wealthy buyers, often with cash reserves, face no such constraints and continue purchasing properties. This disparity exacerbates the split between struggling towns and resilient regions, creating a two-speed property market. Investors and institutional buyers are noticing these patterns too. Some see opportunity, snapping up undervalued properties in regions hit hardest by forced sales. Others pull back, fearing further drops. The result is uneven liquidity. Some areas experience heavy transaction volumes at discounted prices, while others barely move. Government interventions can't easily fix this. Policies like Help to Buy or interest rate freezes may provide temporary relief, but they often don't address the underlying mismatch between regional debt levels and income. Structural issues, such as the concentration of buy-to-let investors in certain cities, mean some areas are more exposed to shocks than others. Understanding this dynamic is critical. The combination of human behavior, bank caution, and uneven investment creates a complex web that shapes the property market far more than simple national averages suggest. Savvy players who grasp these nuances can anticipate price shifts long before headlines report them. In conclusion, the UK property market is entering a period of unprecedented division and complexity. While some regions face potential crises with homeowners forced to sell due to rising mortgage costs, others remain relatively insulated, buoyed by wealthy investors and cash buyers. The disparity between cities and towns highlights the risk of oversimplified national statistics. Averages can hide dramatic local variations. For homeowners, the message is clear. Understanding your local market, your mortgage terms, and your financial flexibility is more critical than ever. Those with expiring fixed-rate deals need to plan proactively, explore refinancing options, and consider how sudden interest rate hikes might impact monthly budgets. For potential buyers, the landscape offers both risks and opportunities. Certain towns may present bargains for those prepared to move quickly, while other areas may continue to resist downward pressure. Investors, too, must adjust strategies. Long-term stability now depends on careful selection of resilient locations and properties with strong rental demand. Opportunistic buying in distressed markets could yield significant returns, but only for those who fully understand the dynamics at play. Ultimately, the next 12 to 18 months will be a defining period for UK property. The combination of expiring mortgage deals, rising rates, regional disparities, and shifting investor behavior is creating a market that is far from uniform. Savvy participants, whether homeowners, buyers, or investors, who pay attention to these subtleties will be best positioned to navigate the challenges and capitalize on the opportunities that lie ahead.